This is the long-distance fight between the two financial management superstars that has captivated the investment community for months. If this duel between these two stars is so exciting, it is above all because these two personalities represent two completely different types of management, two radically opposed approaches. In this video, we're going to try to break down and explain their investment strategy in simple terms, and we'll try to figure out whether Buffett or Wood has the best approach. And make sure to stick around till the end, as we'll look into the 3 valuable lessons to be learned from these two titans. We've got plenty of valuable info headed your way. As always, we don't give financial advice. Everything you choose to trade is under your discretion alone. Despite this, we aim to bring you the most valuable and intelligent ideas from the thought leaders across the finance space. We genuinely believe that the information we provide makes you a better and more informed investor. Okay, with that said, let's jump into it. On one hand, there's Warren Buffett, the Oracle of Omaha, who at the age of 91 is the heir to a wealth of over $110 billion. Warren Buffett is the most successful investor in our time. In the investment world, he's regarded as a legend. At the time of creating this video, his Berkshire Hathaway fund was valued almost $700 billion and was listed on the stock exchange. Over the years, Warren Buffett's management philosophies have been outlined in several books: long-term investing, even extremely long-term investing. Warren Buffett is the most well-known proponent of the value-oriented investment philosophy. He only puts his money on things he understands. He seeks for undervalued companies based on a set of criteria, the most important of which is profitability. As a result, Warren Buffett invests in household names, solid companies with solid performance. Apple, Bank of America, Coca-Cola, American Express, and Moody's are among the companies in Warren Buffett's portfolio. With this managerial style, Warren Buffett has had a good track record. Since 1965, he has outperformed the S&P 500. Warren Buffett earns about 20% each year, compared to 10% for the S&P 500. Buffett's highest returns were earned in the early stages of his career, when he ran his own business, Buffett Partnership Limited. The firm existed from 1957 to 1969, and during that period, the famed investor managed to achieve a staggering 29.5% average annual return on his stock market investments. However, because he employs a relatively simple strategy known as value investing, almost anyone with a rudimentary understanding of finance could replicate his results. As he expressed it once, "You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ always beats the guy with the 130 IQ. Rationality is essential. You need a stable personality." However, because there is always a but, Warren Buffett has underperformed the S&P 500 over the previous decade. Warren Buffett owns Apple stock, but he missed the tech boom, which explains why his stock has underperformed. Some analysts have speculated that the Warren Buffett has simply become a has-been. This was the situation during the dot-com boom, which he refused to embrace. He was dumped in the late 1990s, but when the internet bubble burst, he got his revenge. Opposite Warren Buffett, we have Cathie Wood. Cathie Wood is a leading proponent of the growth investment strategy. She manages the ARK Innovation Fund and has quickly established herself as the muse of the new economy. Cathie Wood has a long and impressive career in financial markets and investments. She's made a name for herself throughout her career as a successful portfolio manager and chief investment officer. She even started her own hedge fund in New York City. Cathie managed $5 billion for AllianceBernstein as chief investment officer. After 12 years, she left to start her venture, which has made her famous across financial market conversations, ARK Invest. ARK ETFs are actively managed and focus on disruptive industries. Although she was well known in many circles beforehand, ARK's investment results have garnered plenty of attention. Because of her expertise in tracking down emerging and disruptive companies, her ETFs have seen great success. Her strategies are often different from the traditional hedge funds and portfolio managers. This has gained her a large following on Wall Street and among retail investors alike. She has great handle on public relations as well, stepping in front of the camera often to speak about her theories and strategies. Cathie Wood's most notable accomplishment is to have invested a significant portion of her assets in Tesla. As a result, the rise in Tesla's stock price has logically benefited her fund. Warren Buffett's management style is the opposite of Cathie Wood's. It's referred to as the growth style in contrast to Warren Buffett's value-oriented management style, which focuses on undervalued companies based on profitability. Growth management, which is Cathie Wood's, focuses on companies that have great growth potential even if they are not profitable. Cathie Wood has made investment in stocks that have skyrocketed in value, such as technology stocks. These are the stocks which have fueled the rise of American indices in recent months, led by Tesla. ARK Innovation was the star of the year 2020, outperforming the competition with a stratospheric performance. The match between Warren Buffett and Cathie Wood seemed to be over, with Wood knocking out Buffett. However, in recent months, the tide has turned. On Wall Street, there is a sector rotation in progress. Investors are exiting some segments of the economy in order to invest in other areas. And in the last few weeks, investors have decided to burn what they have been worshipping for the last few months: technology.
Technology. What is that all about?
As a result, ARK's innovation stock has plummeted by 30% since the beginning of 2022. In only 1 year, the price has dropped by more than 50%. Fearing that the boat may sink, investors are just abandoning it. Now, who is winning this fight? We'll discuss that in a minute. But before that, I'll give you 3 rules that both Warren Buffett and Cathie Wood follow, even if their approach could be viewed as diametrically opposite. Rule number 1, buy business success, not stock gains. This rule didn't actually come from Buffett or Wood. It was famous investor Benjamin Graham who came up with it. The important takeaway from this is that owning a stock means owning a business, which means the stock will only follow the performance of the business. With this in mind, when investing, both Buffett and Wood look at the companies that are going to dominate in the future, not the ones who are doing well today. You should do the same. Look into those with high profit margins, the ones with a big competitive advantage, the ones loved by consumers. If the business does well, your investment will do just as much. Rule number 2, understand what you're buying. This one goes for both Buffett and Wood, and it's very simple, but also fundamental. Know the company you're buying. Perhaps one of the only patterns across Buffett's portfolio is the fact that their businesses he invests are actually very simple. Coca-Cola sells soft drinks. Apple sells iPhone and iPads. Southwest is an airline, and furniture market seems pretty self-explanatory too. If you're passionate about cars, you should look into Ford or Tesla stock. If you're into e-commerce, look into Amazon. If you're into social media, look up Meta, but only buy those who you really understand. Now, you could argue that Cathie Wood is into some pretty cutting-edge tech areas such as DNA sequencing, robotics, artificial intelligence, energy storage, and blockchain technology. These topics are definitely not common knowledge, but Cathie and her team are known to do a lot of research. She understands what she is buying, and so should you. Rule number 3, be fearful when others are greedy, and greedy when others are fearful. When the market keeps going up, and stocks like Apple doubled its value in 24 months, everyone gets greedy. During times like these, people tend to get overconfident in their investing skills, and put even more money into the market, making it harder and harder to find a good deal. That is the call for being cautious. But if there's one thing we could be sure about, the moment panic starts to set in inside the stock market, both Buffett and Wood will be snapping up a lot of stock when they're on sale. Cathie believes that any large market downturn will essentially put powerful growth stocks on sale. And for those that can pick them up at a discount, there are insane upsides. Now, is it possible to call a winner when comparing the approach of Buffett and Wood? True to his lifelong investment philosophy, Warren Buffett continues to move forward slowly but surely. Day by day, Warren Buffett is catching up to Cathie Wood's performance. Warren Buffett, who was knocked out a few months ago, has risen to his feet and is prepared to make his next move. Who do you think will be the winner? I'd love to hear your thoughts in the comment section below. Also, if you want to learn more about Cathie Wood, she just warned of a stock market crash. We made a video on that, so you should go check it out. If you enjoyed this video, please hit the like button to show your appreciation for our efforts, and consider subscribing to Profit Protection. Happy researching, invest safe, and invest smart. We'll see you on the other side. Take care.